So we just discussed some of the options on an external transfer of equity. You also have some options with internal transfers of equity as well. When I say internal, it's more talking about family members, it's talking about management team, it's talking about employees. And you still have a stock or an asset deal that you can do with an internal structure as well. But you also have other options. And when you're looking at an internal structure for equity, the thing that you have to remember is you may not be getting as much value out of this as you would with an external. Because you're looking at your family members and you may not want to charge them so-called full price or full value for your shares. You're looking at a management team and you may not charge them full price or for full value for those shares. And the reason being is because you want to see them taken care of. These are people you dealt with. These are people that you love. When you're looking at an external, you don't know these people for the most part, and you're trying to get as much out of them as possible. Let's discuss a transfer of equity to a family member. Again, with the family member, you may not be looking at having the most cash coming to you at that point in time, because you've built the nest egg of your life's work over a period of time, and you've got a retirement fund set aside that's going to take care of you. You may not want to transfer, or you may not want to receive an amount of cash because it complicates your estate plan going forward as well on that future growth of all that cash. So one of the things that you may want to consider doing is an outright gift, or some mix between an outright gift and a cash amount. You're allowed to gift a certain amount on an annual basis, tax-free. You're allowed to gift a certain amount during your lifetime on a tax-free basis as well. So if you can mesh your gifting structure with the amount of cash and maybe other mechanisms such as a deferred compensation agreement or a salary continuation agreement, then maybe you can get what you would like out of this and be able to transfer to your children the value of that company, because they're going to continue working in that company. I'll give you an example. I had a situation where the son of the business was running it for a number of years. The dad was semi-active in the company, sort of retired. It was actually a third generation by the time the son was running the business. We were looking to transfer that equity from the father to the son. The major concern of the father was being taken care of for life. He wanted to make sure he had sufficient income to live the rest of his life. He didn't care right now about receiving a lump sum number because he wanted the livelihood of that company to continue, and he knew that if he demanded a large dollar amount, one, his son wasn't going to be able to afford it, and secondly, it would put an uneasy burden on the company itself. So we structured a deal as such that there was a partial gift of the stock to the son, which again, tax-free. There's no cash outlay on behalf of the son. There's no cash outlay on behalf of the dad. And there's no cash outlay on behalf of the company. So that was a good mechanism from that standpoint. We also entered into a deferred compensation or salary continuation agreement for a period of time with him, which gave him that sufficient cash flow for the rest of his life. And we provided health insurance and other items. It gave him comfort. He knew he was taken care of at that point in time. The downside to that whole structure, quite honestly, is if the company fails, he has nothing left. So he's putting his complete faith in his family to be able to continue that business. Fortunately, it worked out quite well. There's also charity mechanisms that you can use in order to transfer equity within the company. If you've got an outside party that is maybe interested in buying it, but you still want to take care of your children, and they still want to be active, you can use various items, a charitable remainder trust, a charitable lead trust. All these things get a portion of the dollars to your favorite charity while still giving a residual or maybe a front-end amount to your family and taking care of them as well. So those are the types of things. There's also other estate planning mechanisms, a grantor retained annuity trust that can be utilized to transfer shares of a stock very cheaply, but get it out of your estate and get the value to your children or to your family. Very good mechanisms to be looking at and utilizing. Another mechanism to transfer is to key management. If you don't have any family involved in the business, your family is set from the backside and said, Dad, Mom, we're happy with what we're doing. You've built a great life for us, but we'd like to pursue other interests. So your management team has been there with you, and they're the ones that are still there putting in the hours with you, and they're doing everything and building the value of that company for you. They may be a very good option to transfer the equity to and unlock that value for you. Again, the downside is that it puts a semi-burden on the company from the standpoint that, generally speaking, you're going to have to go to the company in order to finance this buyout. It's not like an outside person coming to you with a bunch of cash and saying, here, I want your stock. And they're going to pay you based on some number and you can walk away. This is going to be your management team financing it through the cash flow of the company at that point in time. So there is a burden on that company, and you've got to make sure when you're looking at the numbers and looking at the payout figures that makes sense, that you're going to be able to cash flow that deal. Because you don't want to get down to the end of the day where the management team says we can't make the payments, and now all of a sudden you're back with the stock with the company that's failing, that you left that was doing very well. So you've got to make sure that the structure meets those objectives, that you're going to be able to cash flow and be able to not worry about them making those payments.